So I want you to picture something. If you earn, let's say, $250,000 a year.
Right, which is a massive amount of money.
It is. You are objectively in the top 5% of earners on the planet. I mean, you have surpassed 95% of humanity in pure income generation.
Yeah, absolutely.
Yet there was this recent and honestly just terrifying survey that showed roughly 1 in 3 people making over $250,000 a year are living completely paycheck to paycheck.
It's wild to even think about.
Just sit with that for a second. How is that even mathematically possible? Because we are surrounded by people who have these incredible incomes, top-tier educations, all this professional drive, and yet they are literally one missed paycheck away from a total financial crisis.
Yeah.
So today on Amateurology, we are taking on a mission for our deep dive into the source material that feels, well, incredibly urgent. And personal, really, to almost everyone listening. We are exploring the ultimate modern paradox, which is the broke high earner.
It is such a profound paradox because, logically, if you have a massive income, you should have absolute peace of mind. You should be sleeping incredibly soundly at night.
You'd think so, right?
Right. But when you actually look at the psychological state of the modern professional workforce, that is rarely the case. I mean, we are living in the most affluent society in human history. We're surrounded by climate-controlled homes and pocket-sized supercomputers.
Yeah, all the conveniences.
Exactly. Yet so many of us are stuck in this exhausting, perpetual loop between the grindstone and the home. Like we are burning out at absolute record rates just to maintain a baseline existence.
And if you're listening to this right now, maybe on your commute or at the gym, this might hit really close to home. Because you might be, say, a mid-level manager or a software engineer or maybe part of a dual-income household.
Right. People doing everything, quote-unquote, right.
Right. Exactly. You are earning what your parents would have considered a king's ransom. But if you're being completely honest with yourself, you just feel constantly strapped for cash. There's this baseline hum of anxiety about the future.
Yeah, that low-level panic.
Yes, about unexpected bills or whether you will ever actually be able to step off the treadmill. And I want to say right up front, you are definitely not alone in this.
Not at all.
But today, we are not going to insult your intelligence by giving you like a bulleted list of budgeting hacks.
Well, please no. No latte math today.
Right, exactly. We're not going to tell you your core problem is buying too much coffee or that you just need to clip more digital coupons. That is not what this deep dive into the source material is about.
Because those superficial fixes completely miss the underlying architecture of the whole problem. Today, we're going entirely under the hood. We're constructing a unified mental framework. We're bringing in the hard mechanics of behavioral economics, evolutionary psychology, the mathematics of risk, and even millennia of financial history.
It's a big scope.
It is. But the goal is to explain exactly why human beings are essentially hardwired to fail at managing money in the modern world. And, more importantly, how shifting our fundamental operational definition of what wealth actually is can completely break that exhausting cycle.
So we really have to start by looking at the game board itself. Because to understand why highly intelligent people are failing, we have to acknowledge that the rules of the game have basically changed underneath our feet.
They absolutely have.
If we look back a few decades, society presented us with this very linear, very predictable script for financial success. We can call it the traditional wealth ladder.
Yeah, the wealth ladder was in many ways the foundational social contract of the mid-20th century. And it was highly visible. It was highly structured.
Walk us through what that actually looked like for a typical person back then.
Well, you went to university, which, by the way, you could often pay for with just a part-time summer job.
Which is mind-blowing today.
Oh, totally unimaginable now.
Yeah.
But then you graduated, you got a stable corporate job that offered a defined benefit pension. You got married, rented an apartment for maybe a couple of years to save a modest down payment.
Right.
And then you bought a starter house.
Right. And then you just sort of rode the wave.
Exactly. As your career progressed, your salary naturally increased with inflation and seniority. You accumulated property wealth, maybe you upgraded the house once or twice, and eventually you retired comfortably on this really predictable combination of that corporate pension, Social Security, and your significant home equity.
It sounds so simple.
It was a step-by-step, nearly guaranteed process if you simply followed the rules.
It was this highly visible, very comforting path. You could literally look at the person 10 years older than you at the company and know exactly where you were going to be. But today, if we're being honest, that traditional path feels completely clogged, if not just entirely shattered. We're looking at an economic landscape characterized by incredibly complex lending rules and housing costs that wildly, I mean aggressively, outpace middle-class wage growth.
Oh, the housing decoupling is staggering.
It really is. Plus, shifting unpredictable interest rates that just change the math on a mortgage overnight. So the rungs on that ladder aren't just slippery now. In many places, they're entirely missing.
And the psychological consequence of those missing rungs is this deep, pervasive anxiety. When the traditional path breaks down, people look at their financial reality, they run the numbers on a basic calculator, and they realize the math simply doesn't work. Not the way they were promised it would, anyway.
Right.
The fear is no longer just about keeping up with the Joneses. It has devolved into a literal fear of sheer survival.
Wow. Survival. That's a strong word for people making six figures.
But it's true. There is a very real, very palpable terror among the working class and the upper middle class today. That they, or their children, will literally have to work until they are 100 years old just to afford basic living expenses.
And we are seeing the leading edge of this right now, aren't we? In aging economies around the world.
We absolutely are. If you look at economies that are a few decades ahead of the demographic curve, it is increasingly common to see 75 or 80-year-old citizens working in highly physical, demanding jobs.
Like what?
Working as toll booth operators or night security guards or traffic directors standing out in the freezing cold, because their retirement savings simply cannot sustain them in a low-yield, high-cost world. That image, that's what haunts the modern high earner. They are running as fast as they can because they are terrified of becoming that 80-year-old toll booth worker.
Okay, that is a truly terrifying image, and it completely validates the anxiety so many of us feel, but I have to push back here for a second.
Go for it.
Because if the system is really that broken, and if the ladder is truly missing its rungs, then why does it look like everyone else is succeeding wildly?
I am.
I mean, when I drive down the street, I am surrounded by $90,000 luxury SUVs. I open social media, and my peers, people with my exact same job title, are taking these lavish, incredibly expensive vacations to the Swiss Alps.
Overwater bungalows in the Maldives.
Yes! Or they're wearing designer clothes that cost more than my first car. So if the math of the economy is so brutal right now, how is it mathematically possible that everyone looks so incredibly rich?
That question cuts to the absolute core of the modern financial paradox. What you are describing and what you feel when you scroll through your feed is the deadly confusion between being rich and being wealthy.
Okay, define those for us.
Yeah.
Because people use them interchangeably.
They do, but they are vastly different. This is what we call the visibility trap. We have to fundamentally understand that modern capitalism is an incredibly brilliant, highly optimized engine for two distinct things. First, it is an engine for generating actual wealth and technological innovation.
Sure, raising the global standard of living.
Right. But second, and far more dangerously for the individual, it is an engine dedicated to helping people fake wealth.
Fake it? You mean they don't actually have the money they're spending? Are they just drowning in credit card debt?
Well, some of them are definitely drowning in debt, yes. But it's deeper than just credit cards. It's about defining our terms, because rich and wealthy are not just semantics. They describe completely different, often opposing states of being. Being rich is strictly about current income and current consumption. It is highly visible by design.
Right, because you want people to see it.
Exactly. When you are sitting at a stoplight and you see someone driving a brand new, custom-ordered $100,000 sports car, you are seeing someone who is rich. That simply means they had the high income or the credit capacity to acquire that specific vehicle on that specific day.
Right. It signals to me this person has a lot of money.
But here's the massive psychological blind spot that our brains just completely fail to process. The only objective mathematical data point you actually have about their finances in that moment is that they now have $100,000 less in their bank account than they did yesterday.
Wow.
Or, if they financed it, they are now $100,000 more in debt, and they are contractually obligated to pay a bank a huge portion of their future labor.
Okay, let me pause on that. Because we're so deeply conditioned to see the car as the wealth. But seeing the car doesn't tell me they have $100,000. It explicitly tells me they spent $100,000. They literally separated themselves from that money.
Precisely. They exchanged actual wealth, which is liquid capital that gives you options, for a depreciating piece of metal that immediately loses 20% of its value the second its tires touch the public road. Wealth, on the other hand, is the exact opposite of the sports car.
What is it then?
Wealth is what you do not see. Wealth is the unbought cars. It is the skipped first-class upgrades. It is the luxury watch left sitting in the jewelry store display case. Wealth is financial assets, stocks, bonds, real estate equity, cash that have not yet been converted into visible consumer goods.
That is so counterintuitive to how human beings operate, though. We are fundamentally visual creatures. We assess our environment, our safety, and our social standing based entirely on what we can physically see.
And that biological reality is exactly why wealth building is so incredibly difficult to learn by observation. Think about any other complex skill you might want to master in life. If you want to become a world-class tennis player, you can watch the greats.
Right. You watch Wimbledon.
Exactly. You can pull up footage of a champion. You can study their exact footwork, the precise angle of their racket, their follow-through, their breathing. You can literally observe mastery in real time and mimic it. Or if you want to be a great writer, you can read the masters. The finished product is right there on the page to be dissected.
But you can't observe wealth.
Exactly. How do you observe restraint? By definition, true wealth is hidden. You cannot see the zeros in your neighbor's index fund account. You cannot physically see the fact that they pay off their credit card in full every single month. You cannot see their discipline.
You only see what they buy.
Right. All you can ever see is their consumption. So when people try to act wealthy by mimicking what they see successful people doing, they are almost always just mimicking the depletion of wealth. They are copying the exact actions that destroy capital.
We are copying the wrong side of the ledger. We are copying the spending, completely blind to the saving. I love this concept, and it reminds me perfectly of the diet and exercise analogy, which I know is a big part of the source material we're looking at today.
It's a fantastic analogy.
I want to really build this out because I think it perfectly captures the psychology of the high-earning professional who ends up broke. Think about how human beings behave when they decide they want to get in shape. They start a new workout regimen. They go to the gym, they get on the treadmill, they sweat profusely, they push their heart rate up for 45 minutes.
It's hard work.
It is. And the little digital screen on the machine tells them they burned, let's say, 400 calories. But human beings are notoriously terrible at estimating caloric burn versus caloric intake. We chronically overestimate how hard we worked, and we massively underestimate how much we consume.
Oh, 100%. And what inevitably happens when they walk out of those gym doors?
They walk out feeling incredibly proud of themselves, their ego is inflated, the endorphins are pumping, and they think, well, I worked incredibly hard today, I suffered on that treadmill, I earned a reward.
There's the danger word. Earned.
Exactly. So they go straight to a restaurant and eat a massive 1,200-calorie burger with a side of fries and a beer. They use the visible, painful, undeniable effort of the workout to justify a massive consumption of calories. And ultimately, the math is unforgiving.
It always is.
The 1,200-calorie meal completely cancels out the 400-calorie workout, leaving them with an 800-calorie surplus. They literally gain weight despite exercising vigorously every day.
That is a flawless one-to-one parallel to how high-income professionals handle their money.
How so?
Think about the professional who works an 80-hour week. They deal with incredibly stressful client negotiations, they close a massive deal, or they finally get that significant promotion to vice president that they've been grinding for. They feel the fatigue in their bones.
Yeah, they're exhausted.
They feel the stress, the missed family dinners, the sacrifice of their time and youth. And they tell themselves, I work incredibly hard for this money. I suffered for it. I deserve this $10,000 luxury watch. I deserve to lease the newest BMW. I deserve the massive kitchen renovation.
They use the high income, which is the financial equivalent of the grueling treadmill workout, to justify massive, immediate lifestyle consumption.
Exactly. And just like the 1,200-calorie burger completely cancels the treadmill effort, the luxury purchases completely cancel out the high salary. At the end of the month, the bank account is just as empty as it was when they were making half as much money.
That's devastating.
It is. True wealth, just like true weight loss, requires the quiet, invisible, often very painful discipline to decline the meal. It requires you to create a mathematical gap between what you can do and what you choose to do.
So if you burn the calories and then actively choose not to eat the extra meal, you create a caloric deficit. And that deficit is completely invisible to anyone looking at you in that moment. But over time, day after day, it compounds into actual physical fitness.
Yes, and financially, if you earn a high salary and choose not to upgrade your lifestyle to match it, you create a financial surplus. That surplus is invisible to your neighbors. They might even think you're struggling, because you're driving a 7-year-old sedan.
Right, they might pity you.
Exactly. But over time, That invisible surplus compounds into actual wealth. But here's the crux of the problem. Declining the meal, declining the lifestyle upgrade is agonizingly hard because it requires you to actively suppress your own ego.
Let's transition into that because I really want to pull on this thread of the ego. If wealth is simply unspent income, I mean, if it's literally just a mathematical gap between earning and spending, why is it so agonizingly difficult for very smart, very rational people to just stop spending?
Yeah.
We aren't talking about people who can't do basic arithmetic here.
No, not at all.
The people falling into this trap are structural engineers, specialized physicians, high-level corporate strategists. They understand math.
They understand math perfectly.
Yeah.
But personal finance is rarely about math. It is almost entirely about psychology and biology. Because once you move past a certain basic level of survival and comfort, once you have a safe roof over your head, nutritious food, reliable transportation, and a reasonable amount of modern entertainment, almost all subsequent spending is no longer about utility.
Okay, unpack that. What do you mean by utility?
Well, the physical utility of a $30,000 car and a $100,000 car is virtually identical. They both get you to the grocery store at the exact same speed. They both have air conditioning and Bluetooth. The extra $70,000 is entirely about ego approaching income.
Ego approaching income. That is a brilliant phrase. Let's really break down the mechanics of how that works in someone's head.
It means that your spending ceases to be a tool for acquiring goods and becomes a communicative act. It becomes a megaphone. It is a way of signaling to the outside world, and perhaps more importantly, signaling to yourself that you have achieved a certain status in the hierarchy.
So it's an evolutionary thing.
Deeply evolutionary.
Yeah.
We have to remember that human beings are deeply social, hierarchical evolutionary animals. For hundreds of thousands of years, our survival depended literally on our status within the tribe. If you had low status, you didn't eat. In the distant past, status was signaled by physical strength, hunting prowess, or lineage.
But today we signal it at the mall.
Right. Today, in a modern capitalist society where physical survival is mostly guaranteed, status is almost entirely signaled by consumption.
So when your income rises from a promotion, your deeply ingrained evolutionary hardware basically kicks in. Your ego demands that your external reality reflects that new, elevated status to the rest of the tribe. You want the world to explicitly know you are successful, so they treat you with more respect.
Precisely. Therefore, saving money has very little to do with your financial literacy or your knowledge of tax codes or your investment returns. It has almost everything to do with your humility. Saving is simply the mathematical gap between your ego and your income. If your ego rises in perfect lockstep with your income, your savings will always permanently be zero.
I hear that, and it makes complete logical sense. Saving is the gap between ego and income. But let me play devil's advocate here for a minute.
Yeah.
Because isn't this instinct for comparison totally natural? And more than that, isn't it economically useful? Doesn't the desire to keep up with the neighbors or to emulate the 1% drive us to work harder? I mean, if I see my neighbor build a beautiful new deck, I want one too. So I take on an extra project at work. Doesn't that envy fuel the innovation and productivity that ultimately drives the whole macroeconomic engine forward?
You are absolutely right about the macroeconomy. Envy is an incredible fuel. Modern capitalism relies entirely on that envy to drive relentless production and relentless consumption. If everyone suddenly suppressed their ego and only bought exactly what they needed for basic utility, the global economy would collapse overnight.
Wow, yeah, we'd have a massive recession.
Instant depression. So yes, the system needs you to play the game, but as a personal strategy for individual happiness and wealth building, it is a catastrophic game because it is a game with literally no finish line. The ceiling of social comparison is so astronomically high that virtually no human being on Earth can ever hit it.
Right, it's a ladder where the rungs just keep appearing the higher you climb.
Let's look at the mechanics of the treadmill. Let's say you work incredibly hard, you sacrifice your 20s, you miss all these parties, and you reach a point where you earn $500,000 a year. Statistically, you are in a tiny elite fraction of global earners. You have won the economic lottery.
You should feel victorious.
You should. But human psychology doesn't work that way. You don't look down the ladder at the people earning $50,000 and feel immense gratitude. You look up.
Right, because at $500,000, you probably move to a new neighborhood. You join a new country club. Your peer group changes entirely.
Exactly. You start associating with people who earn $5 million a year, and suddenly your $500,000 salary feels grossly inadequate. You feel like the poorest person in the room. You feel poor compared to the venture capitalist next door whose kids go to a more exclusive private school. So what do? You grind harder.
You try to catch up.
Right, you reach 5 million. But the venture capitalist earning 5 million looks at the hedge fund manager earning 50 million. And the hedge fund manager earning 50 million feels inadequate compared to the tech billionaire who owns a private island. It is a psychological treadmill that only speeds up the faster you run. If you run your financial life based on social comparison, you will never, ever win, because someone will always have more.
So how does an individual step off a treadmill that is built into our very biology and reinforced by, like, every advertisement we see?
You have to forcibly introduce the immensely powerful concept of enough. There's a brilliant foundational equation in behavioral psychology that explains this perfectly. It goes, happiness equals results minus expectations.
Happiness equals results minus expectations. I want everyone listening to just let that formula sink in for a second.
Think about the pure mathematics of it. If your income, your results, doubles over a 5-year period, but your lifestyle expectations also double in that exact same time frame, your net happiness remains exactly zero.
That's depressing, but true.
And your wealth-building capacity remains exactly zero. You've just scaled up the treadmill. The incline is steeper, the speed is faster, the stress is higher, but you haven't moved an inch forward. To actually build wealth and to actually find peace, you have to actively anchor your expectations. You have to define what enough is for you, entirely independent of what your peers are doing. If you cannot define enough, you'll inevitably push your spending, your risk-taking, and your biological stress levels to the absolute breaking point.
I think a massive part of why we fail to define enough is that we take our social and financial cues from people who are playing a completely different game than we are, and we don't even realize it.
Oh, that's a critical blind spot. We look at the market or we look at the culture around us as if everyone is participating in the exact same financial event. We assume there is only one set of rules, but there isn't.
Let's make this tangible with an example. I want to flesh this out. Imagine a 35-year-old professional. Let's say she is a mother of 2. Her core fundamental goal is to save enough money to comfortably pay for her kids' college tuition in 15 years and to retire with dignity in 25 years.
Okay, very standard, very reasonable goals.
Right. Her timeline is measured in decades. Her risk tolerance should be relatively low because she needs stability, she has dependents, and she simply cannot afford to be wiped out. But she logs onto social media or she turns on a mainstream financial news network and she sees people making wild, highly leveraged bets on volatile tech stocks or day trading cryptocurrency options. And these people are bragging about making 200% returns overnight.
And the immediate psychological response is FOMO, the profound fear of missing out. She looks at her boring, globally diversified index fund that is up maybe 7% for the year, and she thinks, I'm doing this wrong, I'm falling behind, I need to be much more aggressive.
Exactly. But she is entirely ignoring the context of the person she is envying. The person bragging on social media might be a 24-year-old day trader who lives in a rented apartment, has zero dependents, and whose entire financial goal is to generate short-term momentum.
Completely different game.
Completely. That 24-year-old can literally afford to go completely bankrupt on a Tuesday, sleep on a friend's couch, and start over on Wednesday. Or the person she is envying might be a highly leveraged real estate flipper who is playing a dangerous game of hot potato with millions of dollars of commercial debt. The day trader and the flipper are playing a game where the timeline is measured in hours or months,
Right.
but the mother is playing a game measured in decades. Taking financial cues from someone playing a different game is like a marathon runner trying to match the explosive, chaotic pacing of a 100-meter sprinter. The marathon runner will physically collapse by mile 2.
That is a perfect transition point, because we've explored the psychology of spending, the visibility trap, and the ego. But we need to pivot and look at the actual mechanics of the money itself. We need to answer the question, why is it that high earners, people who have clearly mastered the incredibly difficult skills required to get money, so often fail to keep it?
It's really baffling when you think about it. You see brilliant neurosurgeons or genius-level software architects or incredibly savvy business owners who build massive multi-million-dollar incomes. They are at the absolute apex of their fields.
Total experts.
Right. And yet they experience catastrophic personal financial ruin. They end up bankrupt or their businesses fold because they overexpanded or they are just drowning in hidden debt. Why doesn't the immense intelligence required to get wealthy perfectly translate into staying wealthy?
Because getting money and keeping money are not the same skill. In fact, they require two completely different, almost diametrically opposed psychological skill sets.
Opposed? How can they be opposed? If you are good with money in one arena, shouldn't you be good with it in the other?
Not at all. Think about the psychological traits required to get money in the first place. To build a successful business from scratch, or to advance to the very top of a hyper-competitive corporate profession, you need profound optimism.
You have to believe it'll work.
Exactly. You need to be inherently willing to take massive risks. You need immense hustle, supreme, almost borderline delusional self-confidence, and a willingness to put yourself out there and disrupt the status quo. You have to look at the statistical odds of failure, which are huge, and deeply believe that you are the exception to the rule.
Right, you need a healthy dose of audacity. You have to
Yeah.
believe you can beat the competition.
Yes, that audacity is what gets you the high income. But keeping money requires the exact opposite mindset. It requires a healthy, persistent dose of paranoia. Yes, paranoia. It requires the constant humbling fear that what you have built could be taken away tomorrow by a changing market, a new competitor, or an unpredictable crisis. It requires extreme humility. The honest acceptance that your past success was likely heavily influenced by random luck and good timing, not just your sheer undeniable brilliance. And it requires frugality,
So the skills cancel each other out.
basically. The specific traits that make you a great entrepreneur, extreme risk tolerance, and unshakable optimism, are the exact same traits that will bankrupt you if you apply them blindly to managing your life savings.
That makes so much sense of a phenomenon I've seen over and over. Take the neurosurgeon example. The neurosurgeon is brilliant in the operating room. He is highly confident, decisive, and he is used to being the absolute smartest, most capable person in any room he walks into.
As he should be in an OR.
Right. But he takes that exact same mindset, that supreme confidence, into his personal investing. He assumes he can outsmart the global stock market, just like he outsmarts a complex neurological disease, so he refuses to buy boring index funds.
Because they're too average for him.
Exactly. Instead, he puts half his net worth into a highly speculative, complex biotech venture that he barely understands, confident his genius will protect him. He ends up losing his shirt. He applies the aggressive getting mindset to the delicate keeping phase.
Exactly. And I want to emphasize that this is not a new, modern phenomenon. It's not just a product of 21st century capitalism or meme stocks. If we look back thousands of years to ancient civilizations, we see that they had already identified this exact flawed human operating system.
Wait, ancient civilizations?
Yes. Take the ancient Babylonians, for example. Babylon was one of the wealthiest, most commercially advanced cities of the ancient world. And their financial records, written on clay tablets that have survived millennia, lay out the fundamental laws of money. And what's fascinating is that the core issue back then was exactly the same. People getting money but failing to keep it, often ending up in literal debt slavery.
So the fundamental mechanics of human greed, risk, and wealth basically haven't changed in thousands of years.
The tools have evolved from clay tablets to supercomputers, sure. But the human hardware hasn't changed a bit. The ancient Babylonian wisdom was incredibly simple in its formulation, yet brutally difficult for humans to actually execute.
What were the rules?
The first law they codified was that a portion of all you earn must be yours to keep. Specifically, they advised setting aside at least 1/10 of your earnings before paying the baker, the shoemaker, or the tax collector. This is the ancient origin of the modern concept of paying yourself first.
Put 10% away immediately.
Right. The second law was that this saved money must be put to profitable, safe labor. It must be invested so it can multiply over time.
But the really interesting part of that ancient wisdom, especially for our high earner paradox, is the explicit warning about how to invest it, right? Because they specifically warned against a concept they called impossible earnings.
Yes, and this is where it perfectly connects to our modern high earner. The ancients deeply understood that money flees from those who try to force it into generating impossible, unnatural returns, or who trust charismatic tricksters and schemers. And this is the exact trap that the modern anxious high earner falls into time and time again.
The trap of forced earnings. Let's unpack the mechanics of that, because it sounds a whole lot like what happened during the recent crypto booms or the wild speculation in zero-revenue tech stocks.
Exactly. Here is how the trap works. A high earner wakes up one day, looks to their bank account, and realizes they haven't saved nearly enough. Their ego is severely bruised because they feel intensely behind where they believe they should be given their prestigious job title and massive salary.
They feel the panic setting in.
So what do? They panic. They don't want to do the slow, boring, unglamorous work of saving 10% of their income and waiting 20 years for compound interest to do its job. They want a shortcut. They want to fix a decade of overspending in 6 months.
Which is mathematically impossible without massive risk.
Exactly. So they seek out absurdly high-yield, high-risk investments. They try to force their small pool of money to work exponentially harder to make up for their lack of historical savings discipline.
And because they are highly intelligent in their own specific field, as we discussed with the surgeon, they assume they can understand this totally unrelated, highly complex, incredibly risky investment vehicle.
Right.
They trust their own inexperience, or worse, they trust a charismatic trickster on the internet selling a dream of guaranteed double-digit monthly returns.
And they lose it all. The bubble bursts, the scheme collapses, or the leveraged bet goes against them. They ignore the boring, undeniable math of long-term compounding because compounding requires time and patience, and they are in a desperate rush. They violate the fundamental law of keeping money safe, all because their ego cannot tolerate the slow, steady path. They let their anxiety override their intellect.
Okay, let me step into the shoes of the skeptical listener right now.
Bring it on.
Let's say I'm listening to this on my drive, and I think, all right, I hear you both. I get it. I'm not going to buy the flashy $100,000 car. I'm not going to try to keep up with the billionaire next door. And I'm definitely not going to invest my life savings in some crazy speculative scheme offering impossible earning.
Okay, good start.
I am a rational, analytical high earner. I sit down on a Sunday afternoon and I build a flawless, meticulously detailed 30-year financial spreadsheet. I model my income growth at a conservative 3% a year. I calculate exactly what my mortgage will be. I project my kids' future college tuition based on historical inflation. And I model my diversified stock portfolio to return an average of 8% a year. Everything balances perfectly. My plan is flawless. What could possibly go wrong?
What could go wrong is that you live in reality, and you do not live on a spreadsheet. And reality is exclusively governed by the black swan.
The black swan. This is a crucial concept, and I want to spend significant time here because understanding this fundamentally changes how you view risk.
The term black swan describes a massive, highly consequential, deeply unpredictable, and exceedingly rare event that simply cannot be forecasted by looking at historical data. Our spreadsheets, our financial models, our entire way of planning for the future are built on the assumption that the future will roughly resemble the past.
Right, we extrapolate.
We take the average of the last 50 years and project it forward. But human history is not driven by the predictable, ordinary, average events. History is violently driven by the sudden, massive, unimaginable shocks.
Give me some tangible examples of a black swan, both on a macro scale and on a personal micro scale for the listener.
On a macro scale, it could be a sudden global pandemic that literally shuts down the entire global economy overnight, freezing supply chains and destroying industries in a matter of weeks.
Nobody had that in their 2019 spreadsheet.
Exactly. Or it could be a global financial meltdown, like we saw in 2008, where the entire banking system nearly collapsed and erased half the value of the stock market in a month.
Right.
Or it could be a sudden exponential technological shift, like the rapid emergence of advanced artificial intelligence that completely wipes out the economic value of your highly specialized professional skills, rendering your degree totally useless.
And on the personal side.
On a personal, micro scale, a black swan could be a sudden, severe health crisis, a cancer diagnosis, or a horrible car accident that physically prevents you from working for 3 years. You cannot model these things in a spreadsheet because, by definition, you do not know they exist or when they will strike until the very moment they happen.
So if we inherently cannot predict them, what on earth are we supposed to do? Do we just throw our hands up in despair, accept that the universe is chaotic, and live in a state of constant panic?
Not at all. We change our entire structural approach to how we build our lives. We have to stop trying to predict the unpredictable event and instead intensely focus on our exposure to the unpredictable event. We have to move our financial lives from being fragile to being robust and ultimately to being anti-fragile.
Fragile, robust, anti-fragile. Let's really dig into this spectrum because I think this is where the mechanics of wealth building really shift from theory to practice. Explain fragility first, and let's use the macro example of the 2008 financial crisis because I think that illustrates it perfectly.
It's an excellent example. In 2008, the global banking system was highly optimized. Banks had complex spreadsheets that showed exactly how much profit they were making by bundling mortgages. They assumed housing prices would always gently rise as they had for decades.
Yeah.
Because they were so confident in their models, they borrowed massive amounts of money, which is leverage, to buy more of these mortgage bonds. They were completely optimized for a stable environment, but they were deeply fragile. The moment a shock occurred, the moment housing prices ticked down just a few percentage points, their entire highly optimized system shattered. They couldn't survive the volatility because they had absolutely no margin for error.
Now, take that exact same macro mechanism of fragility and apply it to the micro level of a personal household.
Let's say you earn $20,000 a month. You are a very high earner. You sit down with your spreadsheet and you optimize your life perfectly. You take out a massive mortgage on a dream home, you sign leases on 2 luxury cars, you enroll your kids in expensive private schools, and your total fixed monthly expenses equal exactly $19,000 a month.
Leaving you $1,000.
Right. You are saving $1,000. On your spreadsheet, everything balances. You are maximizing your lifestyle for your income.
It looks efficient. You aren't technically spending more than you make.
But you have built a fragile household. Your financial life is like a delicate wine glass sitting right on the edge of a table. You have created a system with a single catastrophic point of failure. The uninterrupted continuation of your high salary.
Which we know isn't guaranteed.
Exactly. If a personal black swan hits, if you get laid off during a recession, if your industry is disrupted, or if you get sick, you don't just experience a minor temporary setback. You shatter. You immediately default on the massive mortgage, the cars get repossessed, you have to pull your kids out of their school, your marriage comes under immense stress. Your entire life shatters because you optimize for perfection, and you cannot survive a shock.
So how do you avoid that? What is the opposite? You mentioned robust.
Robust is better than fragile. A robust system, like a solid block of iron, can take a shock and remain exactly the same. It doesn't break, but it doesn't improve either. But we want to push our lives a step further. The true opposite of fragile is anti-fragile. An anti-fragile system is one that actually benefits from shocks, volatility, and disorder. It thrives and grows stronger when things get messy and chaotic.
Now that sounds like magic. How can a person's finances possibly benefit from an economic disaster or a market crash?
It comes down to 2 absolute pillars: how you handle leverage and how you build your margins of safety. Let's start with leverage, which is just the financial term for debt. Leverage is the absolute devil of fragility. Leverage takes a routine, manageable, everyday risk and chemically accelerates it into a ruinous, unrecoverable disaster.
Let's look at the math of ruin, because I think people don't intuitively grasp how punishing losses actually are.
Yeah.
Let's use investing as an example.
Let's use the stock market because it's highly liquid. If you invest $100,000 of your own cash and the market drops by 30% during a recession, your portfolio is now worth $70,000. That is painful, but it's a paper loss. You still have the shares, you aren't forced to sell, and you can wait for the market to recover. Now look at the math of recovery. To get from $70,000 back to your original $100,000, you don't need a 30% gain.
Right.
You need roughly a 43% gain just to break even.
Because the base of your capital shrank. 30% down requires 43% up just to get back to zero. That's a steep hill, but it's manageable if you have time.
Exactly. But what if you use leverage? What if you borrowed money on margin to invest? Let's say you put down $50,000 and borrowed $50,000. When the market drops 30%, your total portfolio value drops to $70,000. But you still owe the broker $50,000.
Oh, wow.
Your actual personal equity has dropped from $50,000 to $20,000. You just lost 60% of your money in a 30% market drop. And worse, the broker might issue a margin call, forcing you to sell at the absolute bottom to pay them back. You are permanently wiped out. Leverage turned a routine market fluctuation into total, irreversible ruin.
So permanently removing leverage, paying off all consumer debt, avoiding margin, being very conservative with mortgage debt. That is step 1 toward anti-fragility. It removes the mechanism that causes ruin. What's step 2?
Building a massive, almost unreasonably large margin of safety. A margin of safety isn't just about accepting lower returns on a portion of your money. It's about ensuring absolute survival. The primary goal of managing your money isn't necessarily to maximize your compounding wealth every single month. The primary goal is to ensure you can stay in the game long enough for compounding to actually work its magic over decades.
Okay, I have to push back hard here because
Right.
this is where the highly analytical listener is going to scream at their player. We're constantly taught to optimize. We want every single dollar working efficiently. Having a huge chunk of cash, say a year's worth of living expenses or $100,000, Just sitting in a boring bank account earning minimal interest feels incredibly inefficient.
I know it does.
In fact, if inflation is running at 3 or 4% and my cash is earning 1%, I am mathematically losing purchasing power every single day. That doesn't feel like a life raft. It feels like a leaky boat. Why would I accept guaranteed losses to inflation just to have a margin of safety?
That is the classic optimization argument, and it is entirely wrong when you factor in the reality of black swans. Yes, inflation will slowly eat away at the purchasing power of cash, but you have to reframe how you view that cash. That cash is not an investment designed to yield a return. That cash is a premium you are paying for an insurance policy that guarantees your financial survival and autonomy. It is the price of anti-fragility.
An insurance premium. That completely changes the framing.
When a black swan hits the economy, let's say a severe recession hits, the fragile person who optimized every dollar into the market and holds zero cash loses their job. To pay their massive mortgage, they are physically forced to sell their stock portfolio at the exact moment the market has crashed 40%. They lock in catastrophic, permanent losses just to survive the month. But the anti-fragile person,
What happens to them?
the person who accepted a slight drag from inflation to hold a massive cash buffer, when they lose their job, they don't panic. They don't sell a single share of their investments. Their cash buffer covers their life for a year.
And it gets better than just surviving, right? This is where the anti-fragility actually kicks in.
Exactly.
Yeah.
Because they have a massive cash buffer and zero debt, they don't just survive the crash, they capitalize on it. While the fragile people are forced to liquidate, the anti-fragile person uses a portion of their cash to buy incredibly high-quality assets, real estate, index funds, businesses at severely depressed, once-in-a-decade prices. The volatility of the world actually made them significantly wealthier in the long run. They benefited from the disorder because their margin of safety gave them the capital and the psychological calmness to act when everyone else was panicking.
That is a total paradigm shift. You accept the minor, predictable loss of inflation to protect against the catastrophic, unpredictable loss of ruin. But there is another massive, unpredictable variable in that flawless 30-year spreadsheet that we haven't even touched on yet. We've talked about not being able to predict the macroeconomy, but there is an even bigger danger. We cannot predict ourselves.
Ah, yes. The end of history illusion. This is one of the most profound and dangerous psychological blind spots human beings possess, and it wrecks financial plans constantly.
Let's really explore this. The end of history illusion is a psychological phenomenon where we as individuals tend to believe that whoever we are right now, today, in this exact moment, is exactly who we will be for the rest of our lives. It's fascinating because we clearly recognize our past changes. If you stop a 35-year-old on the street and ask them, are you the same person you were at 25?
Good laugh.
They will almost always laugh and say, of course not. I was an idiot at 25. My tastes have changed. My values are totally different. My priorities shifted. We acknowledge past evolution. But if you ask that exact same 35-year-old, will you be a fundamentally different person at 45? They usually pause and say, no, I think I've pretty much figured out who I am now. My personality is set.
It is persistent delusion. We constantly, drastically underestimate our capacity for future change. We assume the history of our personal evolution has ended today. And this creates a massive structural financial hazard. Let's go back to that highly optimized, fragile lifestyle.
Okay, let's picture them.
Imagine the 25-year-old, highly ambitious professional. They are single, they have boundless energy, and they're obsessed with career status. They want the corner office, they want the luxury condo downtown, and they want the European sports car. And they might be perfectly happily willing to grind 80 hours a week in a high-stress job to pay for those things. So, based on the desires of their 25-year-old self, they lock themselves into a 30-year mortgage and massive 5-year car loans.
They assume they will always want to work 80 hours a week to fund that specific lifestyle.
Right. But then they turn 35. Maybe they get married. Maybe they have a child. Or maybe they just experience a severe burnout. Suddenly, their values completely shift. That corner office no longer looks like a trophy. It looks like a prison cell, keeping them away from their toddler. They are physically and emotionally exhausted. They realize they just want to work part-time or start a low-stress consulting business from home, or take a lower-paying job at a nonprofit that actually gives them a sense of meaning.
But they can't. They are completely trapped.
They are trapped by their past self. They've chained their future, highly evolved, tired self to the massive financial obligations created by a younger version of themselves who literally no longer exists. They optimize their entire financial life for a static, unchanging identity, completely forgetting that human beings are dynamic and constantly evolving. This is why keeping your fixed costs incredibly low and maintaining a huge margin of safety isn't just about protecting yourself from a global stock market crash. It's about protecting yourself from you. It gives your future self the financial flexibility to completely change their mind about what they want out of life without having to face bankruptcy to do it.
Okay, so if we synthesize all of this so far, we are terrible at predicting the future macroeconomy. We are terrible at predicting our own future personal desires. And optimizing our high income into equally high fixed expenses makes us dangerously fragile to both of those things. So how exactly do we practically build wealth? What is the actual structural mechanism we should adopt if the middle path is broken?
We adopt a framework that essentially operates like a barbell strategy for life.
A barbell strategy. I want everyone to literally picture a weightlifting barbell in their minds right now. You have massive, heavy iron weights on both extreme ends of the bar and absolutely nothing but empty space in the middle.
Exactly. The barbell strategy is a mechanical way to achieve anti-fragility by combining two absolute extremes, completely avoiding the murky, highly risky middle ground where most high earners live. On one extreme end of the barbell, you have hyper-conservative, almost paranoid safety. You lower your lifestyle footprint dramatically. You aggressively ignore what the neighbors think of your car or your house. You completely eliminate all of your personal consumer debt. You build that massive, almost unreasonable margin of error in your cash savings that we discussed. You make your daily baseline survival completely, undeniably bomb-proof.
You completely eliminate the risk of total ruin. If the worst happens, your baseline life does not change.
Right. If you cannot be ruined, you can survive the bad days. Now, on the other extreme end of the barbell, because your daily survival is absolutely guaranteed by the safe side, you can afford to take highly calculated risks that have massive, uncapped potential upside. You can invest heavily in globally diversified equities that will compound over decades. You can use some surplus cash to start a side business. You can invest in a volatile asset class.
So instead of taking a medium risk with your entire life, like getting a massive leveraged mortgage that you can probably afford if nothing ever goes wrong, which is what the fragile high earner does, you take absolutely zero risk with your core survival, and you take high calculated risk with your surplus capital.
Exactly. The middle is where people get wiped out. The middle is where you think you are safe because you are following the crowd and doing what everyone else is doing, but you are actually highly leveraged and deeply fragile. The barbell protects you from the negative black swans because your cash buffer absorbs the blow while fully exposing you to the positive black swans, like a massive bull market or a successful business venture.
But there is a massive psychological cost to the investment side of that barbell. When you invest in equities or any growth asset with high upside, the value is going to fluctuate wildly. And for a lot of highly analytical, control-oriented high earners, that volatility is agonizing. Let me give you an analogy for how it feels. When I log into my brokerage account and I see that the overall market has dropped 10% in a single week, erasing tens of thousands of dollars of my hard-earned money, it feels like I am being violently punished. It feels like I was speeding on the highway and a police officer just handed me a massive, painful traffic ticket. It feels like a fine for doing something wrong.
That is an incredibly common reaction, especially for high achievers who are used to controlling their environment. But it represents a fundamental, critical framing error. We are culturally conditioned from childhood to view negative financial events as fines. If you get a parking ticket, it means you broke the rules, you made a mistake, and you should change your behavior to avoid getting another ticket in the future. So when the stock market drops 20%, investors physically feel like they were fined. And what do?
They change their behavior.
Yes. They panic, they sell all their assets at the bottom, and they vow never to invest again to avoid future fines. But in the realm of wealth building, volatility is not a fine, it is a fee.
A fee. Walk me through the psychological difference between a fine and a fee.
Think about taking your family to a massive amusement park, like Disneyland. The ticket to get in the gate might cost $150 per person. When you hand over your credit card and pay that money, you do not think, I am being punished for coming to Disneyland. I am paying a fine for a mistake. You recognize, rationally, that the money is simply the price of admission. It is the required fee for the experience, the thrill of the rides, and the joy of the day. It is a known, expected, and acceptable cost of doing business.
Okay, I see exactly where you're going with this.
Long-term compounding, the kind of compounding that builds generational, life-changing wealth, is the ultimate financial theme park. It's the greatest wealth-generating engine ever created by humanity. But the ticket to ride that engine is not free. And the crucial thing to understand is that the fee is not paid in cash. It is paid in emotional resilience during periods of severe volatility, uncertainty, and terrifying market crashes. The fear, the doubt, the anxiety in the pit of your stomach when your portfolio drops 30% during a recession, that is the admission fee.
If you can internalize that, if you can truly view it as a fee instead of a fine, it completely changes your physical and emotional reaction to a market crash.
Precisely. If you view volatility as a fee, you stop trying to avoid it. When you try to avoid a fee, you try to time the market. You jump in and out, trying to dodge the down days. And historically, mathematically, that inevitably leads to buying high when you feel safe and selling low when you feel panicked. You end up paying far more in the long run. But if you accept that volatility is just a completely normal cost of admission to the compounding machine, you pay the fee willingly. You strap yourself into the ride, you endure the terrifying stomach-dropping dips without closing your eyes, and you simply wait until the ride comes to a complete stop at the end of your multi-decade time horizon.
That reframing is incredibly liberating. It takes the panic out of the process. But it brings us to the ultimate question, really the culmination of this entire framework we've built today. Why do we do this? Why should a highly educated, hardworking high earner actively suppress their ego? Why should they drive a reliable 10-year-old Honda instead of leasing a brand new Mercedes? Why should they endure the emotional fee of market volatility? If we are just quietly hoarding unspent wealth in index funds until we are too old to enjoy it, what is the actual point? Capitalism provides amazing, beautiful, enjoyable luxury goods. We only live once. Why shouldn't we enjoy the fruits of our labor today?
Because capitalism provides something infinitely more valuable and infinitely more deeply satisfying than luxury goods. It provides freedom.
Mhm.
And that is the ultimate, truest definition of wealth. The highest dividend that money pays is not a sports car, a bigger house, or a gold Rolex. The highest dividend money pays is autonomy.
Autonomy, the unencumbered ability to control your own time.
Exactly. It is the profound ability to wake up every single morning, look at the day ahead, and say, I can do whatever I want today with whoever I want for as long as I want. That is what unspent hidden wealth actually buys you. It buys you optionality. When you have a massive gap between your high income and your suppressed ego, when you have absolutely zero debt, and when you have a compounding margin of safety acting as your anti-fragile buffer, you are no longer a hostage to your own salary. You can walk away from a toxic boss without a second thought. You can take a year off to raise your child during their most formative years. You can completely pivot to a new career that pays half as much but brings you deep, profound joy and low stress.
You literally buy your way out of the frantic loop between the grindstone and the home. You buy yourself out of the panic.
Yes. The luxury car is just a piece of rapidly depreciating metal that requires maintenance and insurance. But autonomy is the very fabric of a meaningful, self-directed life. The broke high earner is trapped precisely because they have traded their future autonomy for current, highly visible status. They have traded their finite time on Earth for objects to impress people playing a different game. To permanently break the cycle, you have to realize that the single most valuable thing you can ever purchase in a capitalist society is your own time.
So let's summarize this synthesized mental model we've built today for this deep dive into the source material because we have covered a huge amount of ground. We fail to build wealth not because we lack intelligence or math skills or even income, but because we misunderstand the fundamental nature of the game we are playing. We mistake highly visible, ego-driven spending for actual wealth, falling blindly into the visibility trap. We let our ego rise in perfect lockstep with our income, running on a psychological treadmill of social comparison that has absolutely no finish line.
That's right.
We wrongly, dangerously assume that our audacity and optimism in getting money means we have the humility and paranoia required to keep it. And by optimizing our lives to match our high incomes through massive leverage, we make ourselves deeply structurally fragile to the unpredictable black swans of the world, while simultaneously trapping our future, evolved selves in a lifestyle they may no longer want.
Perfectly stated.
Hmm?
And the mechanical solution to all of this is to adopt the barbell attitude. We remove the leverage that causes ruin, we lower the ego that demands consumption, and we build a massive margin of safety to become truly anti-fragile. We willingly pay the emotional fee of volatility to let our capital compound over decades. And we do all of this not to just hoard cash like a dragon, but to purchase the ultimate return on investment, the autonomy to control our own time, our own stress levels, and our own lives.
It is a complete foundational rewiring of how we perceive success in the modern world. It takes the power away from the external display of status and puts it entirely back into your own internal control.
It does. It shifts the defining metric of a successful life from what you own to how much freedom you possess.
I want to leave you with a final thought to mull over, something to take with you the next time you are out in the world, surrounded by the dizzying, overwhelming affluence of modern society. The next time you are sitting in traffic on your commute, feeling the stress of the day, and you see someone pull up next to you in a pristine, massive, six-figure luxury vehicle, instead of feeling that familiar biological pang of envy, ask yourself a fundamentally different question. Am I truly envious of the depreciating metal and leather they temporarily possess? Or am I envious of the time, the peace of mind, and the future freedom they likely had to sacrifice to a bank to pay for it? True wealth whispers, it doesn't shout. Which voice are you listening to? Thank you for tuning in to Amatrology. We'll see you next time.